Let's talk about a very important feature of the zones. We will see, as we have discussed in previous videos, that a zone is a valid zone when it takes out an opposing zone in the same time frame being detected, or it breaks a trend line in that same time frame. That's good. That's good. Okay. But that doesn't mean that it's a tradable zone. You have to assess many other variables like the curve, how high it is or how low, the altitude in the curve, if a higher time frame area is in control, or if it is too wicky, the base is too wicky, we've got overextension and all that. So the basics are these, but then you have to take into account other pieces of the puzzle in order to make our very well, a high probability decision. So let's talk about the tradable versus non-tradable zone. A valid zone at any given time frame is only tradable if it complies with the multiple time frame analysis and the sequence. What does that mean? That you need to apply the sequence. You need to analyze each time frame independently, those time frames that you have chosen in your sequence, like monthly, weekly, daily, or weekly, daily, 4 hour, or 4 hour, 1 hour, 30 minute, whatever you're trading. Okay? You have that sequence, you analyze each time frame independently, and then you link all time frames together and you obtain a sequence. You locate which is the time frame out of alignment, and then you make a decision. That's very important. And also, it is very important that trading lower time frames areas of demand, for example, into higher time frame areas of supply in control is never a good idea. So let's take a look at the charts and let's talk about the tradable versus non-tradable, the tradability of a zone. Okay, we are always using the Aussie as an example. So this is the Aussie chart right now on the daily. Okay, let's switch. Okay, we can see this is the daily Aussie. We've been talking about these areas. On these areas, we've got almost everything about on the strategy. So I don't need to switch to another pair to demonstrate or show you how the market works according to these rules. There are many other ways of describing how the market works, but we are talking about supply and demand imbalances by the rules laid out as set and forget. So we've got a big rally in price, okay, and we've got a big drop in price. You may be wondering why or what caused this drop and this rally and also this reaction from this area, because well, here to the left is nothing, looks like, and here we've got a big imbalance. Okay, so we need to make our top-down analysis. So if we start drawing the trend line like that, and we make it a more aggressive trend line linking all these areas, we've got that this is an area of demand, level on top of level, 2 levels. Let me draw them like one only. We've got another level. Okay, there are other levels down there, etc., etc. This is another area. This is the origin. Okay, we're not going to draw that. And then we've got another descending trend line over there connecting the latest two peaks. So now the daily is in a downtrend as per definition. So now let's take a look at also here the break of the trend line confirms that potential imbalance as supply. It also took out this area of demand, so it is valid by the two main reasons of why a level is considered supply. This belongs to another lesson. So you should watch that video before proceeding to this one. Now let's see why did price, it doesn't always happen like that, but most likely, why did price react to that area? If we are using the monthly, weekly, and daily time frame combination for our position type of trade, sequence and realignment, then we will switch to the monthly and see what do we have here. We've got a monthly area of supply that has been offshort, but there was another area down there, up there. Okay, level on top of level, reaction to that one, and prices reacted to monthly area of supply. Here we've got another area down there, here, over there, and all that. On the monthly, this removed area. So let's take a look at this. We have this. So why did price react to that zone, as you can see on the daily? Because it hit a monthly area of supply. If we take a look to the weekly area, weekly time frame, we've got a weekly area of supply. Why? Because we had that ascending trend line and that was broken, and it also removed the opposing area of demand. So price is reacting to fresh area of supply nested up area and an area of supply on the monthly, weekly, monthly nested areas. Now we've got this. As we were rallying from here, okay, from there, we connected this peak with another peak, okay. This area over there was the one, wasn't it, that broke the trend line. So this is supply. So if that's supply, then this is demand. Okay, this has to do with the previous lesson. Well, when is a new imbalance confirmed as a potential supply? In this case, it took out opposing zone demand, or it broke a trend line. What did that? It took out the trend line. So we've got a valid area of demand. So now price is reacting to that nested area, the daily was nested within the weekly area of demand, but the highest time frame area in control there is the weekly. It is valid because it removed this opposing area according to the rules. So price is reacting to the higher zone because of that, and then the lower zone because of that. Remember, this hasn't happened always. Many times these areas are not respected at all, and they are removed. But we are talking about probabilities. Trading is not a science. It's just a probability game, and you have to play your odds with these rules or any other set of rules that you decide to trade. And these are set of rules. You may have other nuances or trading other strategy, but we are trading probabilities only. Okay, so this is how it works. Even though this is a daily level, a nice daily level of demand, we are too high in the curve and they are lower probability if that area on the monthly took control. Okay, very high over there. Okay, and then price dropped, and this is also supply because we removed that area of demand that removed this area of supply. Okay, this is valid supply because it broke the trend line, removed several areas of demand. So when price rallies over here, it breaks that supply area. What breaks that supply area? This is demand area. Demand area took out this area of supply. They are connected. Okay, connection. So when price drops, this area becomes supply. Very wide and nested up there. So we wait for confirmation for shorts and all that. Those are other lessons. When price drops, and we have taken many shorts on the way down. Okay. So price drops, and now it hits a weekly area of demand right there. Because we still are this monthly, we are respecting the trend line. On this weekly, monthly and the weekly, on the monthly we're respecting the ascending trend line and all that. Those are other videos and lessons that we have covered already, so you should watch them. So but we are talking about how to locate zones and when a zone is tradable and not tradable. So this area over there over here, they were tradable because all these areas because we didn't have the weekly area of demand in control. Now the weekly area of demand is in control. This level over here that remove this little area of demand, okay, is valid supply, but a bigger time frame than itself, which is the daily, okay, is in control, a weekly area of demand. So can this area work of supply over here? Yes, it can. But now we have a higher time frame area in control. We go back to this lesson. We are talking about trading lower time frames daily, in this case, into higher time frames, demand zone, in this case, supply versus demand, and this higher time frame area of demand weekly is in control is never a good idea. Can it work? Yes. Confluence with 20 EMA and all that, it could work. Okay, but waiting for confirmation is the way to go, because normally a bigger time frame area wins over a lower time frame area. Okay, so this is it. Hopefully you will have this a little bit more clear in your mind.